So far in 2026, the Nasdaq is down about 2%. The S&P 500 is struggling to stay green. And one of the most boring ETFs in the market is up 14% year to date. And since January 1st, 2024, that's over 750 days ago, I've been investing $5 every single day into that boring ETF, SCHD, and another $5 every single day into VTI, the total US stock market ETF. And right now, the boring one is winning. Is the AI-driven market officially over, or is something bigger shifting? Let's look at the numbers. Let's start with where the market actually stands right now in 2026, because most people aren't paying attention to this yet. When people say the market, they usually mean the S&P 500. We'll use VU to track that. It's an ETF that mirrors the S&P 500 almost exactly. Year to date in 2026, VU is down 0.76%. Okay, maybe that's just the S&P 500. What about the entire US market? That's VTI, every publicly traded company in America. VTI is down 0.36%, still negative. But what about tech? Because if AI is booming and tech is unstoppable, the Nasdaq should be winning, right? The tech-heavy QQQ ETF is down over 2% year to date. Now here's where it gets interesting. SCHD, a dividend ETF that most growth investors don't even think about, is up 14.4% year to date. On January 1st, 2024, I started a simple experiment. Every single day, I invest $5 into SCHD and $5 into VTI. The market isn't open every day, so on trading days, I adjust the contributions to cover weekends and holidays, whatever I need to get my $5 accounted for every day. And today is February 15th, 2026. That means this experiment has been running for 777 days, which is a pretty cool number when you think about it, but I promise I didn't plan that. It just happens to be where we are today when I'm making this video. Anyway, what I did plan was showing up every single day and letting the data speak for itself. So far, I've invested $3,885 into each ETF. Same money, same days, same market conditions. Here's where both accounts stand as of today. SCHD has a current value of $4,719. That's a total return of $834 or 21.48%. My VTI position has a current value of $4,617. That's a total return of $732 or 18.85%. SCHD is clearly ahead in this snapshot. If we haven't met yet, my name is Steve. This channel is all about long-term investing, clarity over hype, and building real income. I don't chase hot stocks. I don't time the market. I just track what actually works with real money. Let's look at the dividends, because this is actually why SCHD is ahead. SCHD has paid me $159.74 in dividends since starting this challenge. VTI has paid me $55.96 in dividends. That is nearly 3 times more income paid to me from SCHD, which makes sense as it is a dividend fund. For both ETFs, every single dividend received has been reinvested quietly, buying more shares, growing my position, and compounding forward. The price appreciation between the two has actually been fairly close. Those higher dividends paid by SCHD are what created that performance gap. And the most surprising part isn't even the overall totals. It's what's happened just this year in 2026. Is SCHD just getting lucky? Is this a short-term fluke? I don't think so. Markets rotate, and 2026 so far looks like a rotation year. The kind of year where the strategy that got ignored during the AI boom quietly moves to the front of the line. Here are 5 reasons why this is happening. And these aren't just relevant to SCHD, they explain how markets actually work in cycles. Reason number 1, mega cap concentration risk. VTI and VU are market cap weighted. That means the biggest companies automatically get the biggest slice of every dollar you invest. The top handful of mega cap tech names makes up a massive portion of those funds. When those stocks are running, VTI and VU look unstoppable. But here's what's happened in 2026. Several of those mega cap tech companies revealed massive AI spending plans for the coming years. And that spooked investors because while AI spending sounds exciting, on paper it makes these companies look less profitable in the near term. Money started rotating out of those top names, and when they cool, the index cools with them, even if hundreds of other companies are doing just fine. SCHD is built around a completely different set of businesses, and right now, that is working in its favor. Reason number 2 is SCHD holds meaningful exposure to energy, industrials, financials, and consumer staples. These are the exact sectors that have been quietly leading in 2026 as investors have rotated away from expensive tech. And here's the key thing, SCHD didn't have to chase the rotation, it was already there. While VTI investors were watching their mega cap positions weigh on performance, SCHD holders were sitting in the sector that money was flowing into. When the tide shifts, what you're already holding matters enormously. Reason number 3, the math of valuations. During the AI boom, investors were willing to pay a significant premium for growth. But SCHD's portfolio trades meaningfully cheaper than the S&P 500 and especially the tech-heavy NASDAQ. When uncertainty creeps in and earnings growth gets tested, investors start caring about what they're actually paying. Cheap cash flow beats expensive promises when the mood shifts. And SCHD was already on the right side of that valuation gap before any of this started. Reason number 4, the quality filter. This isn't just any dividend fund. To get into SCHD, a company must have paid dividends for at least 10 consecutive years, show strong return on equity, solid cash flow, and a sustainable payout ratio. That filter creates a portfolio of financially proven businesses, not the most exciting names, but the ones that have demonstrated they can perform through multiple market cycles. When the outlook gets murky, investors naturally gravitate toward that kind of stability, not because it's flashy, but because it's reliable. And reliable becomes very attractive when the alternative is watching growth holdings give back gains. Reason number 5, the income snowball. In 2024, SCHD paid me $42.75 in total dividends for the year. In 2025, it paid me $116.99. That is nearly a 3 times increase in just 1 year. Now, most of that growth comes from me owning more shares because I'm investing $5 every single day. My position keeps growing. But here's the other part that most people overlook. SCHD itself increases its dividend payment over time. The companies in SCHD are required to have a history of consistent dividend growth, which means every year, many of those underlying businesses are paying more per share than they did the year before. So you're getting hit with a double compounding effect. Your share count is going up from reinvestments and new contributions, and the dividend per share is also going up as these companies grow their payouts. That's why my income nearly tripled in just 1 year. Over very long time periods, we're talking 10, 15, 20 years, total market index funds like VTI have historically outperformed dividend strategies. That track record is real, and I'm not going to pretend otherwise. So I'm not sitting here telling you that SCHD is the better ETF forever. I'm not. What I am saying is this: markets move in cycles. In 2023, 2024, and 2025, mega cap tech dominated, and VTI benefited enormously. Right now, in early 2026, leadership has shifted toward value, cash flow, and income. That doesn't mean it stays this way. Here's what could flip this market again, and fast. If the Fed cuts rates aggressively, AI spending reaccelerates, and the big tech names start running again, VTI could close this gap in a matter of months. Mega cap growth is not dead. It is pausing. So what am I actually doing with all of this? Nothing different. I keep investing $5 a day into both. Same amount, same discipline, same schedule, regardless of which one is winning at any given moment. Because the point was never to pick a winner. The point was to stay consistent through every type of market. The tech-dominated years, the rotation years, the uncertain ones. This is just one snapshot of an ongoing journey. Tomorrow, I'll invest another $5 into each fund. Next month, I'll keep going. And at some point down the road, I'll check back in and we'll see how the story has evolved. Because that's what long-term investing actually looks like. Not dramatic decisions, not market timing, just showing up every single day and letting time and compounding do the work. And if you want to see how many shares of SCHD you need to own to pay you $100 a month, or how about how much you need to cover a house payment, or even how much SCHD you need to own to retire tomorrow, then I think you'll love this video right here. Thanks for watching, take care, and I will see you next time.